Let's start with a brief overview of what this discussion will cover today. We'll journey through why investing matters for your future financial security, how to understand your net worth and risk tolerance, the basics of key investment vehicles like stocks, bonds, mutual funds, and ETFs, strategic concepts like dollar cost averaging and compounding, and finally practical tips on brokerage accounts and getting started with investing. This will be a continuous, engaging conversation designed to make these concepts clear and approachable for everyone. Imagine for a moment that building your financial base is all about the present, but building your assets is all about the future. The future, as you might guess, promises to be expensive. You have life events ahead like buying cars which cost tens of thousands of dollars, purchasing houses that can easily run into six figures, and college tuition fees for children that range from tens of thousands to even hundreds of thousands, depending on where they study. And then there's retirement, a concept that's particularly daunting for many. You could spend as many years in retirement as you did working, living solely on what you saved, plus any Social Security or pension benefits you receive. To live a similar lifestyle to what you had before retirement, you might need over $1 million saved. It's essential to recognize that successful saving for these big expenses is almost impossible without investing. Many people shy away from investing because the options seem overwhelming: precious metals, options, futures, commodities, ETFs, annuities. The list feels endless. But the good news is, most individual investors need not venture beyond three basic investments: stocks, bonds, and mutual funds. In fact, many people are well served by the simplicity and diversification provided by mutual funds, which bundle together various assets efficiently and at low cost. Investing is not some mystical, scary art requiring luck or insider tips. Although the jargon like asset allocation might sound complicated, it's really about simply dividing your money among different types of investments to spread risk and maximize returns. Millions of people manage their investments successfully while working regular jobs such as nurses or electricians. In reality, being an investor just means putting money to work in some investment. Even with little investment knowledge, simply choosing a low-cost index fund in your 401k makes you an investor. Now, before diving into investment choices, we begin with the most basic step: knowing your net worth. Think of it like a financial thermometer. It shows where you stand at any particular moment. Your net worth is simply the total value of your assets minus your total debts. Next, crucially, is understanding your tolerance for risk. Risk in investing means the possibility of losing some or all of your initial investment. Even seemingly safe assets like U.S. Treasury bonds carry risk, because if you sell before maturity, their value could be less than what you paid. Risk ranges from very low in Treasury bonds to much higher in startup stocks. You must know your comfort level. Do you want fast growth and are willing to handle ups and downs? Or do you want to preserve your capital and avoid losses at all costs? Investors often behave irrationally when it comes to money and risk. For example, when offered a sure $50 or a coin flip to win $100 or nothing, many choose the sure $50. But if they start with losing $50, more people are willing to gamble with the coin flip to get back their money, even if it risks losing even more. The lesson is understanding your own risk tolerance is key to sticking with your investment plans calmly through market ups and downs instead of making panic-driven decisions. Once you know your risk profile, you'll want to consider your investment time horizon, that is, how long you expect to hold your investments before needing the cash. Short-term investing is for money needed within a few years, like a house down payment or college expenses. So you want safer, less volatile investments. Long-term investing, like saving for a retirement decades away, can tolerate more volatility for higher returns, since investment gains have time to recover. Intermediate-term investments fall somewhere between these. Now there's a truly powerful concept called compounding. It's famously described by Albert Einstein as the most powerful force in the universe. Compounding means that not only does the money you invest earn returns, but the returns themselves earn returns, growing exponentially over time. For example, starting with $1,000 invested at a 10% average annual return, after 5 years you'd have about $1,611. And with patience over 30 years, that grows dramatically to over $17,000. This snowball effect is the real magic behind long-term investing. But before rushing out to buy stocks and bonds, you need a solid foundation. The first foundation block is an emergency fund, a savings buffer to protect your family in times of urgent need or crisis. This is your financial safety net. Alongside building this fund, you should start saving for retirement. Ideally through a company-sponsored plan like a 401k, or if unavailable, an individual retirement account IRA. You can build these simultaneously by, for example, splitting your monthly savings between emergency savings and retirement contributions. Once those are in place, saving for a home is often the next step, assuming home ownership is a goal, while a house is primarily for shelter. It is often the largest asset most people own, and historically appreciates roughly alongside inflation, making it a sound long-term investment. Plus, tax advantages on mortgage interest and property taxes make home ownership financially beneficial. The final leg in this foundation is investing outside of your retirement accounts, since retirement funds typically have penalties for early withdrawal. It's important to have money invested in more accessible brokerage or mutual fund accounts for future needs. This step means understanding brokerage accounts, what types exist and which best suits your circumstances. When buying stocks or mutual funds, you don't go directly to the stock exchange. You use a brokerage firm. These come in two main types: full-service brokers and discount brokers. Full-service brokers like Merrill Lynch or Morgan Stanley offer personalized advice, research, and portfolio management, but usually require large account minimums and charge higher fees. They charge either commissions on trades or yearly fees based on assets managed. Discount brokers like Fidelity, Charles Schwab, or Trade are internet-based platforms for investors who want to manage their own accounts, make their own choices, and pay lower fees per trade. While discount brokers traditionally provided basic trade execution, many now offer research tools, advice, and even portfolio management for fees lower than full-service firms. Discount brokers are best for investors who want control and lower costs, especially if they don't trade often. Now, when stepping into the investor vernacular, you'll encounter terms like the PE ratio, which stands for price-to-earnings ratio. This simple measure shows how expensive a stock is compared to the company's earnings. For example, a stock priced at $20 with earnings of $1.25 per share has a PE ratio of 16. Higher PE ratios usually mean investors expect strong future earnings growth, while lower PE ratios indicate muted expectations. Another term is net profit margin. This shows how efficiently a company turns sales into profits after all costs, expressed as a percentage. For instance, technology companies often have high margins around 20%, meaning 20 cents of every dollar in sales is profit. While grocery stores might have margins as low as 1 to 2% due to industry nature. You will also hear about yield, which is the annual income return on an investment, like dividends on stocks or interest from bonds, expressed as a percentage of the current price. Now, for example, if a stock trading at $20 pays $1 a year in dividends, its yield is 5%. Another concept is book value, which is the net worth of a company. What would remain if it sold all assets and paid off debts? Investors sometimes seek stocks trading below book value as potential bargains. Then there's the PEG ratio, which compares the PE ratio to the earnings growth rate. A PEG ratio under 1 might signal a stock is undervalued relative to its growth, while a high PEG might warn of overpriced shares expecting perfect performance. A natural question is, what did I earn? To find your rate of return, you consider the initial amount paid, the selling price, and any dividends or capital gains received during ownership. This helps evaluate whether your investments make money after fees and commissions. However, it's important not to obsess over short-term returns, but focus on maintaining a diversified, long-term approach. Companies also vary by their market capitalization, or cap, indicating their size. Large-cap companies are valued at $5 billion or more, while small-cap and micro-cap companies have much smaller valuations. Large caps tend to grow slower, but are more stable. Micro-caps can grow faster, but are more volatile. If you want to be an investor, but want to avoid effort in picking individual stocks, index funds are a great choice. By investing in an index fund like the S&P 500, you essentially own a broad basket of the largest U.S. companies. This is a set-it dash and dash forget dash it. Strategy that historically grows over time with the market. Exchange-traded funds, or ETFs, take index funds a step further by trading like stocks throughout the day. ETFs offer benefits like easier trading, sometimes lower fees, and a wide variety of index options, from the S&P 500 to commodities like gold or entire countries' stock markets. For those wanting to be more active but still cautious, dollar-cost averaging is a conservative way to build assets over time. You invest a fixed amount regularly, such as monthly or quarterly, regardless of whether prices are high or low. Over time, this strategy lowers your average cost per share since you buy more shares when prices are lower and fewer when they rehire. Dollar-cost averaging is especially effective when combined with direct stock purchase plans or dividend reinvestment plans, which allow you to build positions gradually without extra brokerage fees. While it might seem complex to track all purchases for tax purposes, keeping a detailed worksheet can help. To summarize, today's discussion covered why investing is essential for future expenses beyond saving, the importance of calculating your net worth, and understanding risk tolerance investment basics, including stocks, bonds, mutual funds, and ETFs. Key financial metrics to gauge investments and strategies like compounding and dollar cost averaging that build wealth wisely over time. We also explored brokerage account types and how they fit different investor needs. Thank you for joining this educational journey. If you found this discussion helpful, please like, subscribe, and share it with friends who want to take control of their financial futures. Your support enables more valuable educational content. Remember, investing is about consistent, informed actions toward your goals. Start today and keep it steady for long-term success. Until next time, happy investing and take care.